Hello traders and welcome back to Explain the Charts. Today, September 17th, 2025, we're taking an in-depth look at the NZDUSD pair, which is currently experiencing significant volatility driven by major macroeconomic events. The primary catalyst is the overwhelming market expectation for a dovish shift from the Federal Reserve, with predictions of 3 consecutive 25 basis point interest rate cuts by the end of the year, starting with a decision scheduled for this week. This anticipation has led to a noticeable weakening of the US dollar across the board, creating a dollar-bearish sentiment despite some corporate demand providing minimal resilience. In contrast, the New Zealand dollar, or Kiwi, has found a near-term gust of bidding wind, as reported by FX Street, testing chart territory just south of 0.5980 on Monday and Tuesday. However, the significant 0.6000 handle has remained just out of reach, and some analysts suggest the pair might be running out of bullish gas as it presses into a major resistance zone. Now, let's turn our attention to the one-day chart to understand the broader trends and identify key price levels for NZDUSD. Looking at the daily candles from May 2024 to the present, we can see a period of general consolidation and significant swings, rather than a clear long-term trend, reflecting the uncertainty in global markets. We observed the pair reaching highs near 0.615 to 0.620 in June and then again in late August, but these rallies were met with strong selling pressure, indicating robust resistance at those levels. A critical level to note is around 0.5915, which was cited as the 200-day exponential moving average in recent news. The chart clearly shows that after breaking above this EMA, the market has struggled to establish strong, sustained bullish momentum, often facing resistance in the 0.5980 to 0.6000 range. Zooming in on the very recent price action on the 15-minute chart, covering September 11th through September 16th, we can directly observe the upwards movement mentioned in the news. On Monday, September 15th, price climbed steadily from around 0.595, testing higher levels. This upward pressure continued into Tuesday, September 16th, with the pair pushing above 0.5980 and nearing 0.5990. This short-term rally aligns perfectly with the weakening US dollar narrative and increased optimism surrounding imminent Fed rate cuts. However, notice how the price repeatedly approaches the 0.5980 to 0.5990 area, but fails to break cleanly above it, reinforcing the idea of a significant resistance zone just ahead of the psychological 0.6000 level. Now, let's consider the interplay between this chart data and the news. The market's bullishness on NZDUSD is a direct consequence of the anticipated dovish Fed, and the charts confirm this short-term upward trend. However, the mention of NZDUSD running out of bullish gas and a potential another leg lower is a crucial warning. If the Fed's dot plot released on Wednesday does not align with the market's aggressive rate cut expectations, or if US inflation data surprises to the upside, we could see a swift reversal of this bullish sentiment and a strengthened US dollar, sending NZDUSD lower. Conversely, a clearer dovish signal from the Fed would likely propel NZDUSD beyond the 0.6000 resistance, especially if New Zealand's own economic data due Thursday, such as the Q2 GDP, doesn't disappoint as heavily as the current negative expectations suggest. For traders, key price levels to watch in the short term are the immediate resistance around 0.5980, followed by the significant psychological and technical barrier at 0.6000. A sustained break above 0.6000 could signal a stronger bullish trend, with potential targets around 0.6050 to 0.6100. On the downside, critical support levels appear around the 0.5915 mark, representing the 200-day EMA and a previous consolidation point. If this level breaks, the next support would likely be in the 0.5880 to 0.5890 range, which saw some bouncing in late August. A breach below 0.5880 could open the door for a more significant leg lower, possibly towards the 0.5820 to 0.5850 region seen earlier this year. In the long term, the trajectory of NZDUSD will heavily depend on several factors. The Reserve Bank of New Zealand's policy, China's economic health, and global risk-on sentiment will continue to influence the Kiwi. The current dovish Fed outlook suggests a long-term bullish bias for NZDUSD, provided U.S. economic data remains weak and inflation is perceived to be under control. However, if U.S. inflation picks up meaningfully or the Fed pivots to a less aggressive cutting stance, we could see the U.S. dollar regain strength, pushing NZDUSD lower. Conversely, strong New Zealand macroeconomic data, especially if accompanied by higher dairy prices, would reinforce the Kiwi's strength. To recap, the immediate challenge for NZDUSD is the 0.5980 to 0.6000 resistance zone. A clear break above 0.6000 is approximately 50 to 60% likely if the Fed signals an unambiguously dovish path, reinforced by weak U.S. jobs and CPI data. However, a rejection from this resistance, leading to a drop below 0.5915, is about 40 to 50% likely if the Fed's statement or dot plot is less dovish than expected, or if NZQ2 GDP comes in particularly weak. Traders should closely monitor the Federal Reserve's announcements and New Zealand's Q2 GDP figures on Thursday. Additionally, any news impacting the Chinese economy or dairy prices could serve as significant market movers for the Kiwi, determining whether it extends its current gains or suffers another leg lower. Always remember to manage your risk carefully, as these upcoming events could lead to sharp movements. Thank you for watching Explain the Charts, and good luck with your trades.